morning, good afternoon, good evening, traders from across the globe, and welcome to the 1156th edition of Short-Term Trading Live with Oscar Carboni, and that would be me. Good evening, traders. This video coming at you on a Wednesday night for trading Thursday, that's April 3rd, 2014. Before we get into what's on the board and tomorrow's analysis, let me remind you that futures trading can be extremely risky and can cause substantial financial loss. Futures trading is not suitable for all trading accounts. A stop can be your best friend in this business, and if you do not place stops first, you should not be trading these markets. The volatility is extreme. So, what's going on? Green Omni on the board. Omni's been green for the last couple of days. I know I've been giving you those Camtasia videos, but the Omni has been green. Traders, the markets look fantastic out there, right? U.S. indices advancing nicely, and the bonds are continuing their bearish formation. I will show that formation to you. I will show you why the bonds continue to look bearish. I will show you why the indices look like they're advancing and why we've got the green arrow for trading on Thursday in the U.S. indices. But I will say this. Of all the homework I've done, lots and lots of my homework is pointing straight up in the U.S. indices. But there is one small problem. I showed a chart today in my live trading room, and I said, traders, I am as bullish as the day is long. The Omni's bullish. Everything looks bullish. But the S&P's got a characteristic that's very odd. For the last 4, 5, maybe 6, if you look back, for the last 6 new contract highs that the ES has put in, if the ES is going up, it puts a new high in. The next day has been a down move almost every time. When we put in a new contract high and the market does like a couple of bars and it runs up for a new high, the next day comes down. A new contract high, so the highest level June has ever traded. If you look back at your daily S&P chart, you will find that the day after we make a new contract high, the market pulls back. That is my only reason why I'd be slightly cautious on tomorrow's green arrow. We will buy the dip. We are looking to buy dips. But that one S&P chart that shows me that this happens every time we put a new daily high in is a little bit interesting. So keep that one in mind. All right, traders. So back to what is happening and not what might happen. What is happening is very nice advance so far. Bonds looking to break down. With no further ado, let's go look at some charts. Okay, traders, so the Dow Jones daily bar chart. We were in this wonderful channel for a really long time. The 200 bar moving average gets involved a few months ago. A beautiful hold. We get back to the top of the channel, get under it, get back above it. Another perfect hold of the 200 bar moving average. That takes us over the blue channel. That brings us towards where we are now. We run up a little, come down, and we run up as of Wednesday's close, this afternoon's close. We are right there at previous highs, but we have not taken out those highs yet. We're right there. Will the Dow take out the previous highs? Well, if you look at the other charts that are sisters to the Dow, the transportation average, not only did it take out the previous high, but it did it in the form of a nice bull flag, and we broke out all the way to here so far. Very nice breakout of the double top for the leader. So that tells me if the tranny got through it, the chart you just seen, the Dow Jones Industrial Average, should absolutely get through it. And the S&P has gotten through its previous high, which was here, previous high, right? We got above it as of here. That's as of Wednesday. Today, tomorrow we expect higher. Inverted head and shoulders. The inverted head and shoulders has held. The target on the inverted head and shoulders is 1914. So based on this formation, we should trade up to 1914 before the next big downturn comes. Now, once again, the only thing that bothers me is when we make new contract highs lately, we come off. New contract high, we came off the next day. Tried a new contract high, we came off the next day. You know, each time we've done it lately, when it makes a new contract high, we came right off. Makes me a little worried, but the rest of the chart is extremely bullish. And the NASDAQ, the Dow, the tranny, the Russell, they're all bullish. So probably we'll just continue on like we are doing in the emini S&P. What would keep the emini S&P moving higher and the stocks moving higher? The fact that bonds are continuing their bearish formation. Bond 30-year T-bond chart. This is a weekly, so it's a slightly longer term view. It is not a daily chart, it's a weekly chart. You'll note that the 200 bar moving average is here. When you get near it, about 18 weeks is the duration that you stay underneath or even near the 200 bar moving average, but you almost never get under it. And if you look back at this chart, you will see that the whole chart goes further than you can see. We never seem to get under the 200 bar moving average. If you get near it, it's about 18 weeks. What has happened since? We've gotten under the average. Usually it's 18 weeks. This is week 34, and it's down here. Week 34 below this average. Traders, fund managers use the 200 bar moving average to key off of. I assure you, I am not the only analyst out there that recognizes we are 34 weeks below the 200 bar moving average. That is absolutely long-term sell signal in bonds. Bonds on the weekly chart do not stay below the 200 bar moving average for more than 18 weeks. This is week 34. Then for a day trade, there's a cute little market out there called gold. And what we like about gold for a quick pop tomorrow, Thursday, we should get one, is that lots of reaction seems to take place around my OMNI Trading Academy's proprietary moving average. In other words, when you get near the average, there's a meaningful event that takes place almost always because this average stays out of the market's hair. Well, what's happened here is we bounced and we hit here. I said we get at least one more up day off this average. We are day traders, so we're looking for a small pop in gold. Maybe we'll buy a dip and look for the upside in gold. Traders, pull your own charts, do your own homework. Never accept anyone's opinion on a trade unless you've done your own analysis first. So traders, there is my technical argument for why we've got the green Omni, why we think bonds are going to continue to build that bearish formation, and why we think gold may have a little pop. Traders, if you like these charts, come on down to livewithoscar.com. Come join me in my free trading room. Don't trade alone. There are thousands of Omniacs out there. Hundreds of them come to my chat room every day. We huddle together and we get through these markets. If you would like to join us, it's free. Come on down to livewithoscar.com. All right. One last thing is this. Omni Camp is still scheduled for May 16th through 19th. It's a Friday, Saturday, Sunday, Monday. It's a chance for you to train with me and stay here for 4 days in Vegas, working with me, learning how to come up with Omni calculations, learning how to read the charts. If you would like to spend 4 days with me here in Vegas, come on down to livewithoscar.com, click the OmniCamp application banner on top, fill it out, and I'll be glad to call you back and qualify you. All right, traders, remember, keep your emotions out of trading. One of the best things you can do to help yourselves with that is say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Rock and roll video 1156, and let's take this bad boy higher. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.